you one and all. Hello and welcome to the Daily Finance Wrap. It's your daily dose of personal finance updates covering investments, insurance, loans, real estate, everything to do about your money with expert analysis. We'll also be taking viewers' queries and questions, so keep commenting on our live stream here on this YouTube page, and we'll try and get our experts to answer them for you. I'm your host, Stacey Pereira, and today it's all about deciphering that dilemma. Will he, won't he? The buzz is getting louder as we await whether RBI Governor Shaktikanta Das goes ahead and takes that decision tomorrow to cut repo rates, because that rate cut decision, this is the rate that the RBI lends money to our commercial banks, will have quite a few ramifications, implications on you and me in our personal life too. And that's because maybe your EMIs could come down. A lower borrowing cost could also mean strengthening many industries from housing to infra, even consumer discretionary. So all of them are waiting with fingers crossed to see where really this decision or what lies ahead. But in this kind of scenario, what should you be doing? Where should you be parking your money? We'll discuss the best options for you in this likely scenario. But before that, let me take you through all the top business stories of the day. Let's quickly look at the Indian equity markets, where the benchmark indices extended their gains for the fifth straight session, with the Nifty 50 adding about 240 odd points, ending the session at 24,701. The Sensex too was up by about 809 points, meaning both the benchmarks saw some solid gains in today's session, especially the last bit of trade where you saw a lot of activity, closing by close to 1% for both the benchmarks. Now, except for realty and PSU banks, all the other sectoral indices ended in the green. Remember, information technology stocks saw some big gains today, close to 2% is what just the Nifty IT index added in today's session. But among your big Nifty gainers, we saw TCS, Infosys, Titan, Trend, Dr. Reddy's Labs, all of those among your top gainers in trade, whereas the laggards, we saw stocks like NTPC, HDFC Life, Grasim, Bajaj Auto also was among those that saw some pressure in trade today. Well, like I said, all eyes will now be fixed on RBI's policy decision tomorrow. So we're going to see those rate sensitive pretty much react to any kind of news that comes that way. Another stock that was quite a buzz in this session today was Vodafone Idea. Now, those shares surged as much as 4.5% in today's session, opening at somewhere around 8.79 rupees per share versus the 8.4 that it had closed in the previous session. Now, we also saw this rebound coming after that 52-week low that Vodafone shares saw, reaching that 6.660 on November 22nd itself. So, from that low, that 52-week low, now it's seeing a good steady jump. Now, this increase of flows has come on the back of the announcement that the board is likely to meet and scheduled for December 9, and wherein they will discuss the fundraising issues. And this is something that is quite, has been in the talks for a while. They are looking to raise somewhere close to 2,000 crore rupees. This could be by issue of equity shares or even convertible securities or preferential basis. One will have to wait and see what really comes off that board meeting on December 9. But that definitely was a reason that we saw the stock quite a buzz. And another reason for it could perhaps be that Vodafone Group PLC, that is the main parent company, has now fully exited Indus Towers. They've gone on to sell that remaining 3% stake that they had in Indus Towers, and this happened via a block deal today, which was worth 2,802 crore rupees. Now, the proceeds will now enable Vodafone to repay that 856 crores that it has in borrowings, and then go on to then invest that 1,900 crore back into Indus Towers, which has now become a subsidiary of Bharti Airtel. Now, this whole transaction is expected to, of course, reduce the Indus Towers overdue as well as receivables from Vodafone Idea, and then enhancing the cash flow for Vodafone per se. So that was another reason why you could say that Vodafone was quite a buzz in trade today. And moving on to other asset classes, and we're seeing a lot happen within the crypto space. In fact, Bitcoin today surged past that $100,000 mark. And this was mostly driven by the growth surrounding the incoming administration of Donald Trump in the USA. Now he has also pledged and created this atmosphere of a crypto-friendly regulatory environment. Now, post the US elections, though, we have seen the Bitcoin value almost skyrocket. Just post the election, close to 50% jump, but also overall in the past 1 year, a 137% jump is what the Bitcoin has seen. Of course, Trump's nomination of Paul Atkins as the new SEC chair is also something that is enthused, getting market participant quite enthused, because he is a pro crypto stance, and he's come out quite clearly and said so. This has further, fueled investors' confidence, we could say. And moving on, then, more to do with the RBI, where we are seeing, of course, they are going to be quite in action, and we could hear something on this sort even tomorrow on how they really want to make digital transactions more friendly. And in one step towards that, they have gone on to update that whole framework of offline small valuable digital payments, and this via the UPI route. Now, this because they've gone to increase that transaction limit that you had for UPI Lite. Now, the new UPI Lite, or that single UPI Lite transaction will now be up to 1,000 rupees from initially what was only 500 rupees, while the total limit of these kind of payment to these instruments has been increased to 5,000 rupees, which was earlier 2,000 rupees. Of course, these changes aim to enhance that usability of your offline payments, and also allow transactions without internet connectivity, and promoting the adoption of that digital payment system, which the government has been very much pushing forward to. And let's go to our more interesting conversation then. We are talking about what is likely to happen tomorrow once the RBI comes out with its decision, after it has kept repo rates unchanged at 6.5% ever since May 2023. So that's quite a long term that we've been saying that okay, rates unchanged. Although the last policy, they did change their stance, which went from withdrawal of accommodation to neutral. But what has that really done to the market? It has, of course, enthused participants to think that there is a likely, this rate cut that is coming, and which is why they could see a lot of interest. Now, this doesn't just change things for equities, but also mutual funds, as well as other kind of instruments that you and I would be parking our money in. So, of course, we're talking about unlocking growth opportunities as well. This could be from the finance sector, from housing, from real estate. All of those will have some kind of impact, because remember, a lower borrowing cost could go on to benefit all of these rate sensitive industries that we talk about, right? So what's in it for you and me? Let's try and understand that. Where should we be investing now, just ahead of this, perhaps if it happens, then interest rate cut, or before this whole cycle comes in of easy monetary policy? Helping us answer these questions is Pankaj Mathpal. He's the managing director at Optima Money Managers. Welcome on the show, Pankaj. Let's just get directly started. We've understood this whole scenario. We've been waiting at edge for quite some time now. We are stuck at a repo rate of 6.5%. If in any likelihood the RBI goes on to cut rates tomorrow, which sectors will be the most benefited out of this, and how, and where should one be then buying into? Because of course, we are going to be saying rate sensitives right away, but what all do they entail, and where should one be then picking and choosing?
Good evening, Stacey, and thank you very much for having me on the show. See, if rate cuts happens, most likely there are chances that 25 basis point reduction may be there in rates. If it happens, it will have effect where the sectors which are more sensitive to interest rate, for example, banking, real estate, or auto, where we can see more demand with the rate cuts. So these are the sectors where you can expect. And not only that, in addition to this, like consumption, means there may be more expectation that there will be higher consumption if the rates are low. So these are some themes or sectors where you can see some positive changes. Apart from that, in debt also we know that debt, whether bonds, debentures, or debt-oriented funds, there will be impact on that. And the longer the duration, more will be the sensitivity to the change in the interest rate. So whether equity or debt, there is scope that investors can uh, have some allocation in those sectors.
Right. So you're saying, well, equity, of course, will have, you'll see these rate sensitive stocks. So, these sectors see a spike, perhaps, if at all, it is there is a rate cut that is proposed in tomorrow's policy meet. But if your equities aside, rate cuts also will have that huge impact on bonds and debt funds specifically. Tell us how these get impacted, and what is making them more attractive now once if we do get into this rate cut cycle.
See, either tomorrow or in the next monetary policy, we are expecting that definitely rate cut is expected. So in this case, the time to have higher allocation in debt, because whenever rate comes down, price of bonds or debentures will go up. So it means that you can have better returns from your debt portfolio. Now, as I mentioned earlier as well, that longer the duration, more sensitivity will be there to the instrument. For example, if you have a bond which has a very short duration, in that case, it may not be very sensitive to the rate change. But if you talk about the gilt or long duration bonds or the funds which have uh, uh, government securities or long debt in their underlying portfolio, in that case, you can expect better returns from them. But having said that, does not mean that everybody should invest only in gilt or long duration bond. It will also depend that what is your investment horizon. So based on your financial goals or based on your investment horizon, you have to decide. But as I mentioned, if you expect better returns, it will happen with the long duration debt instruments.
Right. So, just for the benefit of our viewers, basically, bond prices and interest rates have that inverse relationship, which means that if you are looking at an interest rate fall, then your bond price is likely to go up, and which is why your debt funds become quite attractive now because, if they are, especially like Pankaj was mentioning, in the longer duration, then you will actually see that transpire while you keep building on these funds. Now, of course, that result in appreciation is of that bond value as well as our debt fund will hold till you get those higher returns. So that is something that you'll have to wait, and it is a long term strategy at least. But also there are a couple of risks that are involved when it comes to bonds, and how can investors effectively manage them. Now you'll be like, okay, we are expecting a rate cut, so let's look at only debt funds, but there should be a fine balance, one would say. So if you could just throw light on the risks that are associated with bonds and how one should also be mindful of those.
Exactly, Stacy. See, there are majorly two risks. One is interest rate risk, and second is credit risk. So, interest rate risk, as we are talking about this right now, we are expecting that rates are going down. We are expecting rates to go down. It means we are expecting that we will get better returns. But in future, suppose you are investing in a debt instrument or a debt-oriented mutual fund, and rates go up. In that case, it will impact your investment negatively. So that is why one is this, that rate change will impact your returns on your investment. Second is credit. Credit risk is worse than that. I mean, if suppose you invest in some bonds which has a low credit rating or mutual funds which have low rated debt instruments in their portfolio, chances are there that you make better returns. You may expect better returns, but in case there's a default, the issuer of the bond is not able to repay to the fund house, and ultimately it means that NAV will come down. So even if you see debt-oriented mutual funds, there are 16 categories, starting from overnight fund, then liquid fund, ultra short duration fund, money market fund, floater funds, like this, gilt fund, banking and PSU debt fund. So there are 16 categories. First thing you have to decide that what is your investment horizon. As I mentioned earlier, if you are investing, for example, a gilt fund, so gilt fund will have a longer duration. Longer duration means there is these instruments are more sensitive to rate change.
Right.
Second thing, if you talk about credit risk, in gilt fund, there is minimum credit risk, because if you talk about government securities, it means government will not default. But if
Hmm.
you invest in credit risk funds, in credit risk fund, as the name suggests, the underlying bonds are below top rated. It means there
Yeah.
is a more credit risk. So you have to decide that how much risk you want to take and what is your investment horizon.
Right. Absolutely. Okay. We've talked about equity. We've talked about bonds and debt funds. Let's also look at other fixed income instruments such as, fixed deposits or a corporate FD or even a small savings scheme or SSS as they are known. Could this be like, the last opportunity for a fixed deposit investor to lock in those higher interest rates? Because that is also something that will start to change, and you'll be like, why should I also get this? Because you're lowering rates. This is one thing that also has that direct impact. So should one already lock in these higher rates right now that there are currently, and would you still recommend these kind of instruments?
See, Stacy, when we talk about bonds, because bonds are tradable. So bonds are tradable. That is why we see that there can be change in price. But if you talk about fixed deposit, whether the bank fixed deposit or NBFC fixed deposit or small finance bank fixed deposit, or as you mentioned, small savings schemes, post office schemes. So in this case, if you lock your, if you invest in some instrument and if you lock the rate for that period, if the maturity is, for example, 5 years, you are sure that for next 5 years you are going to get same interest rate at what you have booked your investment right now. So, as we have seen that in last couple of months, many banks have increased their rate of interest on fixed deposit. So, if you want to take benefit of that, definitely it's the right time that before rate cut happens and banks pass it on to their investors, to their customers. Before that, only you should open fixed deposit account. You should invest in that. Now, then second thing comes. Uh, Maturity, that how long
Yeah.
means, because in bank FD you know that you may invest in a as low as 3 months FD, or it may be 5 year, or some in some cases 10 years FD also. So if your
Correct.
investment horizon is longer, you should lock at this rate for long term, because what we expect right now that going forward for at least for few years, we are not
Hmm.
expecting high interest rate, because right now we are in the high interest rate cycle, and going forward we are expecting that rate cut would happen at least 3 4 times. So
Right.
considering that fact, you should lock your money for a long term in fixed deposit. But second risk here, credit risk. So credit risk
Hmm.
is still there if you invest in some banks which are not well reputed, or cooperative banks. You have to be more careful, or especially NBFC fixed deposit. So if you want
Right.
to book fixed deposit, then my suggestion would be that either PSU banks or big uh, banks, scheduled commercial bank, I mean, you should consider those banks.
Right. So do see that, if you can, if you have seniors at home, then looking at these savings schemes, or even for senior citizens, that's where the interest rate is much higher. So then these fixed income instruments become quite useful if you do it now, because like Pankaj was mentioning, we are likely to see this rate cut cycle for at least, a few more months now. So if you could lock in your hard-earned money into a fixed deposit with a higher interest rate, then you can change that duration for a longer time, and gain the benefits of that. So that's going to be an interesting way to be looking at how these instruments will also help in you actually getting a source of income through them. But let's also look at now what this could all mean for borrowers, whether it is home loan or auto loan or even personal. Are these going? Are our EMIs going to get cheaper? And should one be looking at only banks or NBFCs? And do we need to be waiting for them to start, passing that on to customers and then go on to take a loan, perhaps? How does this really work out in this scenario? And how does it benefit anyone? Do people who've already taken EMIs also benefit from this?
Stacey, whenever we expect rate change, some will be happy, some will not be so happy, because if you are expecting rate cut, it means uh, on loan you may expect lesser interest. So that is in favor of the borrowers. So
Hmm.
when borrowers are happy, depositors are not so happy, because going forward they will expect lesser interest on their fixed deposit. But yes, as you asked about borrowers, if you are in floating rate, floating interest rate loan, then definitely banks will pass it on, not immediately, but
Hmm.
depending on your interest rate change cycle. Because when you take a loan, for example home loan, it does not happen that every time bank reduces rate or increases, immediately you will see the impact of that. Maybe that your reset period is every 6 months. It means whenever the next 6 month is due for you, next reset is due for you, that time you will see that rate of interest will come down. For the existing investor, existing borrower, I mean, that is the case that wherever the reset happens, that time is they can expect. First thing, bank has to decide after the RBI changes rate of interest. Then they have to decide whether when they want to pass it on to their customer, and after that, that borrower have to see that where when they will be eligible for that based on the reset period as per their contract, as per their agreement. Second thing, for new borrowers, that is the opportunity. Though these days we see that almost all loans are floating rate loans. In this case, if right now they take a loan at a lower interest rate, and going forward interest rate go up, in that case their rate will also change. But with the lower rate of interest, your eligibility for loan goes up. It means,
Yeah.
because when you take loan, that time banks see your repayment capacity. If the interest rate is lower, automatically your borrowing capacity go up. So the means individuals who want to buy house, want to go for car loan, etc., they should
Hmm.
consider taking loan. If not right now, maybe after a few months, because we are expecting rate cuts one after another, at least for few next monetary policy. So one should definitely keep in mind, when rate of interest are lower, you should definitely make best use of that.
Right, so you could perhaps wait for another 1 2 months and then get that lower interest rate, and then go ahead to uh, go and take a loan if you have to. But also remember, from the depositor's side, like Pankaj was mentioning, that you are going to not get those high interest rates that you were expecting, that your money that is parked in with the banks might not see those kind of at least interest capital gains from it. Let's also now get back to our portfolio. If we are looking at building our portfolio, so what kind of stocks would you recommend to either add or sell at this point? When we are looking at least a continued cycle of more rate cuts, if at all, what are the kind of stocks we should be adding, or even good to remove at this juncture?
Stacey, see, I'm not authorized to talk on stocks particularly, but on mutual funds, ETF, definitely I will share some suggestions here. And as I mentioned, that with the rate cut, we are expecting better returns from the sectors like real estate or banking, auto, consumer durables. So investors, first thing, for long term, they should invest in diversified funds or the funds which have higher allocation in these sectors. Second thing, what I recommend always, that investors should have uh, core and satellite portfolio. It means for long term, the higher allocation like 70-80% should be in diversified funds, and 30%, 20% allocation should be in sectoral or thematic funds, whether ETF or mutual funds, but they should have some allocation in themes. So, like we have auto, Nifty Auto ETF, for example, or we have auto and logistic kind of funds, or auto sectoral funds. Similarly, we have banking and financial services mutual funds, or we have real estate ETF as well as mutual fund. So, or consumption funds. So these theme sectors are looking good. So investor can consider some allocation in these themes along with their diversified mutual fund. So that is the only suggestion, that whenever you see some positive from some sectors, particularly or theme, you should increase your allocation, but does not mean that your total investment should be in these sectors only, because in long term we see that sectors keep on rotating. So
Right.
diversified funds or diversified ETF should be a better choice in your portfolio. Stacey, one more
Right.
thing I want to add, because we are discussing about the debt when we talk about bonds or fixed deposit. You
Sure.
also asked about post office scheme. See, going
Hmm.
forward, we are expecting that post office scheme, whether PPF or Sukanya Samriddhi Yojana or monthly income scheme, rates will come down on those schemes as well. So,
Yeah.
what is my suggestion? That because there, what happens, whatever you have invested, whatever you accumulated by now, even rates reduction will impact that corpus as well. So
Sure.
in this case, at least means whatever you invested, you can't do anything. But going forward, because we are not expecting very high return from these instrument, so annual, because the minimum is something, for example, 500 and maximum is 1,50,000 in PPF. My suggestion would be that you should not invest a big amount in such schemes. The minimum or close to minimum amount what is allowed, you should invest. And there are better choices you have, like bonds, etc., not even equity. If we talk about bonds, debenture, etc., where you expect better returns, I
Hmm.
think you should consider those, or debt oriented mutual funds, hybrid fund, etc.
Right. So within the mutual fund space, suppose now I have a lump sum that was lying in a savings scheme, and now you're saying that perhaps if rates are going to fall, I'm not going to get that kind of interest even there. Should I be reallocating this money? And if I'm do, then what kind of funds should I be looking at?
See, again, depending on your goals, your investment horizon, you have to decide. So, if we talk about equity, as I mentioned earlier, some allocation you want to increase or you want to rebalance your portfolio. So, some thematic funds can be added to your portfolio. But
Hmm.
especially we talk about debt, if the money is lying in your account, again, you have to see that what is your investment horizon. If you want to park that money only for 3 6 months, in that case, you have choice like liquid funds or ultra short duration funds. But for long term, banking and PSU debt fund, guild funds, or corporate bond funds, that can be another choice. In addition to this, I'll suggest one more thing, that the investor should consider hybrid fund. The reason is that when you invest in debt funds, if you're in higher tax bracket, especially in that case, you have to pay higher tax, because in debt oriented mutual funds, even um, means there is no short term or long term capital gains. You have to
Yeah.
pay tax on the profit as per your tax slab. So
That's
if you are in 30% tax bracket, you will have to pay 30%. That hurts to the
fine.
investor. So my suggestion would be that in that case, you can invest in hybrid fund. For example, aggressive hybrid fund or balance advantage fund or multi-asset allocation fund. So through this, you will have allocation in debt, because ultimately debt portion will be there, which will give you benefit of this interest rate change. At the same time, that because these kind of hybrid funds, they
Hmm.
qualify for equity taxation. So even if you're higher tax bracket, your long-term capital gain tax will be only that 12.50%. So
Hmm.
if you redeem after 1 year, you are paying only 12.50%, despite you are having in the higher tax bracket. So that does not mean that you have to invest only in debt fund. You can
Hmm.
also invest in a hybrid fund where there's a debt allocation, reasonable allocation is there.
Towards
So that
debt.
can be a strategy.
Right? So hybrid funds could perhaps be a good, or is rather going to see a lot of interest in the coming few days and months, we could say. But what about other asset classes? We saw good rally in gold. Gold prices were being used as that hedge against inflation. Will all of that now start losing sheen? Which other assets can we look at to make an ideal portfolio in this kind of low interest rate scenario?
See, if inflation comes down, so we should say that gold prices also come down, because ultimately gold offers hedge against inflation. But still, see, there's the importance of asset allocation. You must have various asset classes in your portfolio, and something like 10-15% allocation you must have in gold. Second thing,
Hmm.
right now, due to certain other regions, I'm expecting that gold will be able to offer you double digit returns. So considering that fact, I will not say that you should reduce gold exposure in your portfolio. through SIP route or through gold ETF, etc., or sovereign gold bond from the secondary market, you can consider. But some allocation you must have in gold. In addition to this, even I'll say, Stacey, silver is also a good choice. And now in India, because we have silver ETF or silver mutual funds, so I think that one should also consider silver in addition to gold in the portfolio. Coming to real estate, see, real estate, if you want to buy a house for living in that, then definitely you should consider. Though I think that when rate of interest will come down, real estate price will go up because there will be more demand. So it may not be the very right time to buy a real estate or a property if rates go up. But only if you're considering, then also I said, for living only, for a self-occupancy only should consider. For investment, my experience is not so good with the real estate. It happens once in a time that you make some money. But otherwise, in real estate, if you see the CAGR in long term, that is much lesser than your equity.
Absolutely. And also a very long gestation period for that matter to see those kind of returns. But what about real estate stocks or even, jewelry stocks at this point? Are we going to see those something that we could be adding to our portfolio?
See, real estate stocks, or as I said, that ETFs can be considered, no doubt about that. That can be a good choice. Jewelry, etc., stocks, again, you have to see, because we are limited companies, and you have to see that their profitability, because ultimately it's not only that demand of jewelry, but also the how much profit those companies are making when we are talking about jewelry manufacturing companies. Instead of that, I'll say that you add gold and silver directly to your portfolio. Okay. For real estate, I agree with you. Some real estate mutual funds or ETFs can be a choice.
Right. Well, that's quite an interesting and diversified portfolio one can actually build, and especially if we are entering into this low interest rate scenario, there's a lot that we can be picking up that can really help you with a nice, good, healthy returns, we could say. But this anticipated rate cut by the RBI is also something that will boost the economy and those activities which, fundamentally will put India also in a brighter picture. We're going to see perhaps FPI and FII inflows also if we do have that to showcase. But let me take this opportunity to thank Pankaj for giving us his time, helping us understand what we are likely to be getting into and where we should be looking at seeing opportunities and parking our money in that. Thank you so much, Pankaj, for speaking with us and giving us your time.
Thank you very much.
Yeah, well, it is going to be interesting to see what the RBI governor comes up with tomorrow. We could perhaps just be a wait and watch game for longer if he chooses 2025 to be that time when they're getting into the cycle. The Fed has already done it 2 months ago, but that didn't stop him, and he still continued with that, keeping status quo. But hopefully December could be different, and this could also give that much needed spur and push for that Santa rally that we could be expecting on the Lal Street. But we'll have to wait till tomorrow morning, 10 a.m. to know what really the decision is of the RBI when it comes to their bi-monthly monetary policy. Investors, though, must keep an eye out on the different assets which are of the, how they are going to be working around them. We've spoken about a whole host of where you could be looking at great opportunities, and I hope that helps you in building your portfolio. But for now, it's a wrap and goodbye from all of us here that put this show together, the Daily Finance Wrap. Many thanks for watching. We'll be back again with more such insights. Till then, keep watching Personal Finance TV.